Interesting dynamics in financial markets as we head towards the late Wednesday Fed decision. The expectation heading in is that the Fed will leave the target range of the Fed funds rate unchanged while using the meeting as a vehicle to set the stage for rate cuts in the second half of the year. At the moment, odds point towards an 80% chance for a rate cut at the next meeting in July, while the odds for 2 rate cuts in 2019 is even higher at 89%. And yet, despite the Fed's dramatic shift back to the dovish side, the US dollar remains very strong, trading up near its highest level since a rally that began all the way back in mid-2018. The fact that this type of Fed outlook adjustment has not negatively impacted the dollar is a reflection of dovish moves by other major central banks around the globe, and all of this at a time when the world of politics is front and center and almost certainly playing a role in how decisions are made. The Fed's change of pace has been a welcome development for the U.S. administration, with President Trump having been publicly critical of what had been a more restrictive outlook from the central bank. And as far as the political goes, all of this plays into the U.S. administration's strategy of wanting to shake up its relationship with trading partners by way of encouraging a softer U.S. dollar. Lower rates comes with the possible impact of a less attractive U.S. dollar, while a concurrent round of measures on the trade front, including the imposition of tariffs, only adds further downside pressure on the buck. And the Fed doesn't look like it has much choice, needing to assess risks associated with the unpredictable policy from the U.S. administration, while at the same time still getting messages to lean to looser policy, with inflation metrics remaining subdued. And so when assessing FX risk heading into the decision, while we recognize the strong uptrend in the dollar over the past several months, we would also caution against any expectation for this run to continue in a meaningful way. Given the points highlighted on this call, we believe the greater risk going forward is for US dollar underperformance against the other major currencies and downside pressure in risk correlated assets triggered by a realization of accommodative efforts that are exhausted and no longer as effective as they once were. As far as levels go, using euro dollar as a proxy, we expect the major pair to hold up above 110 on a weekly close basis, while a weekly close back above 113.50 will strengthen the case for a major shift in the trend that signals the start to a more secular decline in the US dollar. That's all for now.